Okay, good morning and happy Friday, everyone, and welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. We have quite a number of charts to share with you here today, so let's go ahead and get started. Now, before I do, just a quick disclaimer, what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, like I said, a lot to go over, but we're going to first talk a little bit about the market. We certainly have found a bit of an equilibrium here in the market, so we're talking about how we're viewing the markets, where we think we're headed next. We're going to talk a little bit about economics. So we've been talking about how we felt that the markets got overshot things, and we certainly saw that this week or last week as markets started to pull back. So we're going to talk a little bit about some of the economics and seeing if some of those economic numbers are catching up. If they're not catching up, what trends we're currently seeing. That's exactly what I wanted to give you an update on, because there are some trends that are emerging there that we think are important to think about as we approach the next earnings season, which is just kicking off here in a few weeks. I certainly want to talk a little bit about the COVID increase that we've seen in the US, where we're seeing that increase, what specifically numbers are we focused on in terms of trading, and then talking a little about the different ideas. And first, one of the places that we're starting to look at is overseas. Both Michael and Carter brought up EEM last week on options action. I brought up Brazil earlier this week. Now I want to take a look at Europe. I want to show you some of the markets that we're looking at overseas that we're going to pay attention to. And then we'll take a look at the ideas and sectors for today. And at the end, if we have a couple of minutes, we'll try to do some questions and answers. And thank you so much for everyone that just mentioned that you enjoyed the session with Tom Sosnoff last night. You know, I really enjoyed doing that. And for some great news, actually, I just got this morning, is that we just booked Tom again for August and September. So he'll be coming back. We're going to be doing a slightly different session. We're going to be doing a lightning round strategy session so that we can go over all the different strategies and we can talk with Tom as far as what are his optimal strategies. You know, him and his team have done a substantial amount of back testing, as have we, which is why I really like I really enjoy talking to him, because we can share some of that research, and he's more than happy to share that research, and that's what I love talking to him about that. So hopefully you guys are able to join in that and learn from that as well. So, you know, really right now we're still trying to answer what is the next upside target here for the markets. You know, are we headed higher? Are we headed lower? So that's the answer that we're trying to answer here today. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started. So first, we always talk about the S&P 500. You know, we've had a pretty substantial run here in the S&P 500 over, whether you're looking at it over the last month, last 3 months. And what we saw over the the last few trading sessions is really a bit of a consolidation rather than a pullback. And this consolidation is healthy for markets to continue moving higher. So when the markets move from the 219 lows back to the 280s or so, we consolidated for over a month. And then we had a pretty strong run over the past month, and now we're consolidating again. So the markets have reached this equilibrium state. And I will say that the pullback that we saw last Thursday, Friday, and Monday really took a lot of the momentum or the optimism out of the market. And part of it is because there were fundamental reasons for this pullback. A lot of it due to the increase in terms of COVID-19 cases, but I don't think that's just the only thing that's causing the market a little bit of concern right now. But at this point, the 20-day moving average has still held, right? Which is what we saw here, which is what we saw here. So as of right now, our base case is still continuing to buy the dip, especially with, if you think about all the global central banks, not just the Fed, the ECB, the Bank of England, everyone moving ahead with unlimited QE effectively, and pretty much buying fixed income assets across the board. And when this causes yields to get depressed across treasuries, across corporates, investment grade, and high yield, when you're seeking yield, equities, unfortunately, is one of the last places that you can move your funds into. And that's really why we continue to see flow. Now, I will say that, you know, our optimism here in the market isn't so much in this accelerated phase anymore. It's a much more slower grind, perhaps, higher. So that's still our base case right now, but a much slower move, and we need to adjust our options positions for this slower expectation at the current moment. And our key level that we're still keeping an eye out here is 302 to the downside, 300. So you have a ton of support here with the 20-day moving average, with 300 as a support level. So if it manages to break below 300, then we certainly would say that we're headed back down to perhaps 285 or so. But as of right now, we have a ton of support here in this 300, 310 level, and that's a level that we're expecting to hold. The technology leadership, this is the QQQ, the NASDAQ 100 index, still continues to break to all-time highs. It broke out to all-time highs here last week. It is now flirting back again with that 10,000 level on NDX, which is roughly 250 on QQQ or 245 on QQQ. Let's see if this index can continue to lead higher, because technology continues to be the leader. It's not a leader by much, which is good, because the leadership that we saw here during November through February was all technology. The fact that we're seeing broader participation, and that's been the story for the past few weeks. Broader participation in the markets is healthy. Consolidation we've seen over the past couple of weeks is also healthy for a market to continue higher. But granted, we may not expect it to move at the same speed that it did over the past few weeks. Equal weight S&P 500 index, similar picture. It did overshot a little bit to the upside, pulled back a little bit more violently, but now starting to move higher as well. So broader support of this market. VIX managed to break back below the 20-day moving average yesterday, and we're expecting that to continue today as we're about to open up about half a point higher, 0.5% higher on the S&P. So VIX continuing to decline here. This is, again, a better condition for selling volatility, especially when VIX is still relatively elevated in the 30s or so. And volatility coming down, meaning things are a little bit more stable. That's the ideal conditions for selling volatility. So credit spreads, selling puts, these are the types of strategies that you can deploy here in this type of market condition. Now, oil starting to break out again to the upside. We talked about how it bounced off that $36 resistance level, $35 support level on Tuesday. We said that we're looking for a breakout one way or another. Looks like it's starting to break out to the upside. So we have some names in the energy space that we might want to take a look at as oil continues to see some strength. So that's the broader market that we're paying attention to and how we're viewing it. I do want to catch up a little bit on economics, right? Because over the past, I would say, month, especially a couple of weeks ago, when markets started to really rally and come off those, come off of that trading range, a lot of investors were asking, is this too far, too fast? Are we too disconnected from the economics? And some of the data that's been coming out with the jobs report a couple of Fridays ago, that was substantially better than expected. That caused some of the initial optimism. And recently, we have started to see some of the manufacturing indices, like the Philadelphia Fed that came out yesterday, that came out surprisingly stronger than expected. So economics are playing a little bit of catch up here to the markets while the markets are pausing. And this is generally good, yesterday, we did have a job report that was slightly worse than expected. But I do want to point something out is that, one of the things that we were expecting in terms of the job loss was that the return would be relatively quick. However, as you can see here, over the past few weeks, the number of unemployed has remained fairly elevated and hasn't really seen a tick to the downside. That is concerning to us. And I will say that this isn't particularly surprising, and this is likely going to impact us going into Q3, Q4, Q1. And this might be more of a slow grind rather than the type of catalyst that's going to cause a major market sell-off, but this may be what's causing a bit of a cap here on this current rally. The other thing that I want to point out here is that, we had about 1.5 million jobless claims, initial jobless claims yesterday. That was the news, that was the event that came out yesterday around 9 a.m. And the concerning thing here for us is that, number one, the trend here has stopped slowing down in terms of number of new unemployed. But the difference here between the unemployed here versus the unemployed here is that most of the unemployed here that we were expecting, that we expected that was going to be temporary. However, anyone that's filing for unemployment today is more likely to have more of a permanent job loss, meaning someone who's being let go today or this week is not likely working at a restaurant that had to close because of the lockdowns. These are likely job losses that are going to be more permanent. So the fact that we're still seeing 1.5 million new unemployed people today or this week is concerning going forward, and it's going to make this number, the decline of this number, I think, a little harder to achieve. So those are some of the economics that we're currently paying attention to and some of the concerns that we currently have. Now, one of the things that I would say has caused the current slowdown or the sell-off that we saw last week is really the number of COVID-19 cases in the United States. Now, I've been pointing this out for the past 3 weeks or so that this number the decline of this number has basically stopped. Unfortunately, in the past week, what we've seen is that actually starting to see an increase in terms of COVID-19 cases. And this is unfortunately directly correlated right now to the reopening of states a bit prematurely. I guess it really depends on who you ask as far as whether it's premature or not, but what we are currently seeing is a clear bifurcation now between some of the states that have reopened up early versus some of the states that remain in lockdown, such as the tri-state areas. So unfortunately, in New York City, where I live, things were really bad back here in May and April and June. And this now has come down substantially because even till today, we still remain in lockdown here in New York, but the rest of the country, most of the places have reopened up, and we've seen a significant uptick in terms of cases. This is, and the difficult part here is the fact that there's a large amount of the increase in uptick in terms of cases in Texas, in Florida, and California. Those are three of our largest economies outside of New York, and that is I would say that might have a larger impact on US GDP because between those three states, you're looking at almost 30% of the US GDP in those three states alone. And that is a concern to me as well. And that, again, also may put a bit of a cap here on the market rally if this trend continues and doesn't slow down. So with all of that, we wanted to take a look at, where should we pay attention to, right, with some of this data. So one of the places that we started to look at is really overseas and other countries that perhaps may be doing better or starting to turn a curve and providing, numbers that are looking better. And Europe certainly seems to be one of those places. Most of the European countries are under 1,000 new cases a day versus 30,000 new cases a day in the United States. So Europe as a whole certainly looking much better. So the Euro Stoxx 50, there are some ETFs listed on this if you want to take a look at that. But this is certainly one of the places that we're currently paying attention to. Price action looks very similar here to the US. You had a breakout above 3,000 here on the Euro Stoxx 50, came back to retest the 20-day moving average as support. And we think that this is a potential continuation higher. Once we break above 3,400, which is the last swing high, that's really where you can start moving higher towards 3,600 or so in Europe. And specifically, if you also look at Germany, if we look at the DAX also looking fairly strong, actually a little stronger than the Euro, the Stoxx 50. The DAX, Germany only has about 300-400 cases a day. They did have a recent spike on a meat plant there, but we think that's a fairly isolated event here. So DAX is certainly Germany is certainly one of the countries that we're paying attention to. We think that this can certainly, at the very least, retest that last swing high. And if it can manage to break back above it, then you have the potential for a continuation higher here. So Europe, certainly one of the places we're paying attention to. Asia through EEM. We talked about Brazil. Really start looking at some international countries, especially countries that are doing substantially better than the US in terms of locking down, in terms of controlling their COVID-19 numbers. Certainly one of the places that we think are worth looking at. And some of the yields in some of these European countries are also substantially higher than we're seeing currently here in the S&P 500. So that may also attract some flow into some of those countries. Gold, we've been looking at gold for quite some time now, and gold still remains stuck between this 164, 158, but it is continuing to test the upper bounds here. We are still looking for that breakout. Not sure what's going to happen, but it's certainly one that we're paying attention to. Momentum has slowed down a little here, but money flow remains fairly strong, and we think that that is the potential support that it needs. It's building up potential accumulation here for a breakout. Not sure that it's going to happen, but we are keeping a close eye here on 164. We have alerts that if it breaks above 164, that brings us a potentially much stronger move to the upside here on gold. I did want to give us a bit of an update here on treasuries, because again, as the Fed continues to buy, there was a bit of optimism here a couple of weeks ago when treasuries sold off, when risk kind of really took off because people were selling safe haven assets like treasuries to buy equities, and we saw that substantial rally in equities. This was inversely correlated. That was a very short-lived rally, if you will, here in rates. And the Fed started buying very strongly here into the treasuries market, and the market is back now into this 162, 170 range in terms of TLT. So we certainly think that TLT might continue to trade range bound, but move up to the upper bound here around 170 here. And this is across the board, whether you're looking at treasuries, whether you're looking at LQD, HYG, any of these bond ETFs, major bond ETFs are seeing very similar trends here. LQD almost at all-time highs or testing those all-time highs, HYG starting to continue to move higher here. So as the Fed continues to buy these types of assets, we continue to see support for these to continue moving higher to the upper bound of that range. So, one of the key things that we want to again point out that I talked a little bit at the very beginning about VIX being currently still in the 30s, but vol being relatively low, meaning the volatility of volatility is relatively stable. So when you have a high volatility and volatility that's relatively stable, that provides a good environment for selling strategies. And that's why we flipped a little bit back to selling strategies, over the past couple of weeks as things took off. We're buying options, we're buying, if you think about the CarMax, the Cisco, the AT&T, all Workday, these are all strategies where we were buying, we were using debit spreads because we were trying to reduce our risk and play for a potential upside. But as things slow down, as volatility remains elevated, we are turning back to selling volatility, selling credit spreads, using those types of strategies to utilize for this current market. So at this time, due to some of the concerns that I've mentioned, both with the economics in terms of unemployment numbers and the uptick in COVID-19 numbers, that certainly puts, again, a cap on how bullish we are here in this market. But our base case remains that we want to buy the dips. And we don't necessarily want to buy the dips by buying options. We want to buy these dips by selling options. And we want to be very focused in terms of what sectors that we pay attention to, because we certainly saw a bit of a resurgence in some of the reopening stocks. If you think about the travel stocks that took off a couple of weeks ago and now have pulled back, we certainly talked about how we thought, I think it was last Tuesday where I said that I thought some of those stocks were a little overbought. They went a little too far, too fast. That's exactly what we saw. And I think that if you do see some kind of movement in some of those names, they're going to be much slower. So if you're looking at the airlines, if you're looking at some of the casinos, any of the travel stocks, I don't think it makes a lot of sense to go buy calls in those particular names right now, because again, I think the upside of those are fairly limited. But I do think that if you're going to sell puts, that is a far better approach to some of these names if you think that these are better long-term investments. But some of the emerging trends that we still continue to see is really this technology trend, and specifically technology trends that are facilitating working from home. This is including Zoom technologies. There are so many, DocuSign, OKTA, Team, Work, all of these symbols. These are all symbols that have benefited from working from home. If you want to be less speculative, I would shoot for names like Microsoft or Amazon, mega cap names that are likely going to do well. But on the more speculative side, you have names like CrowdStrike. And the CrowdStrike is interesting to me, first of all, because it's back to its all-time highs around 100. It's now cracking slightly above 100. This might actually have the legs to move substantially higher here, but we did find a credit spread that was collecting about 41% of the width. That's why we're looking at selling a bull put spread here on CrowdStrike. Now, cybersecurity is certainly one of the trends that I think is going to be very interesting post-COVID-19, because there's a lot of concerns right now about people working from home and the security of that, as well as just all of the stocks that have been doing relatively well. Now CrowdStrike actually generates about roughly the same amount of revenue as Zoom, but the stock price is roughly a third of the price of Zoom. So this is really one of the reasons why we want to take a look at this. And for those of you that are concerned about a double top, I would say that we are now starting to break above that double top, and that is really the breakout that we're looking to play. But again, we're using these spreads because we're limiting our risk. We want to do so in a way we're only risking here about 5% of the underlying stock price. So even if this is a double top and we get a big pullback, I'm only risking 5% of the underlying stock price to play for this breakout here in CrowdStrike. I do want to point out here that on the flip side, stocks that should be doing well in a lockdown period, and especially as it starts to reopen, is really starting to fade. And we're seeing this in some of the mega cap names like in Walmart and Costco. But Walmart, being a very strong level here for Walmart of 120. This level has acted as support or resistance multiple times, but is now starting to break below that. So it's starting to move back into this 120, 112 range here. So can it go back above this and start to rally? Certainly can, especially if, let's say, certain things turn around here with COVID-19 cases. Hard to say, but as of right now, our base case is that Walmart, a name like this, may start to trend a little bit lower here and start to maybe trade range bound between 120 and 112. Again, good strategy for selling, right? You don't necessarily want to buy puts here, but selling call spreads makes some sense here. You can collect quite a bit of premium here, sometimes 40, 42% of the, if you sell like something like a 118, 125, 118, 124 call spread here, certainly can potentially make some, you can profit if Walmart stays within this particular range. Costco, another name that is surprisingly weak at this point and is starting to push the lower bound of this 300, 315, 312 range that it's been range bound for most of the last couple of months now, but is now starting to push to the bottom of that range. Now, can it move back to the top of the range? Absolutely. So right now, we're not ready to pull the trigger here on Costco yet, but we're keeping an eye out here on 300. If you see a meaningful break here, there's certainly a lot of room to the downside to that 280 level from 300. So those are some of the bifurcation that we're starting to see in this market. And that's part of why we're seeing the market rally stall, because not all names are now rallying. We're starting to see some names pull back, especially if you look at the number of names that are below its 50-day moving average. It's now about 50%. So 50% of the S&P 500 is above the 50-day moving average, 50% of it is below the 50-day moving average. We've seen a deterioration here over the past couple of days or the past couple of weeks here. So that is going to put a bit of a cap here on the rally, but this also potentially supports a continuation higher after the market consolidates for some time. Lastly, I want to take a look at a name like Chevron. As we saw, energy is starting to break out to the upside. We have that breakout above that $40 level in WTI crude. A name like Chevron, which is one of the stronger names here within the XLE sector, well, one of the things I wanted to note here is that it's below its 20-day moving average, and it's right below its 20-week moving average, but this might be the push that it needs to start moving higher here. And notice that money flow has also started to show that there's been accumulation of the stock over the past few weeks. So this might be The rally in oil here might be what this stock needs to rally back above that 20-day moving average and start moving higher up to that 100, 103 recent high here. So some of the energy names becoming a little bit more interesting to look at, especially when it's trading near the bottom of this range here between 88 and 96, which is predominantly where it's been range bound. And this might be the support it needs to start breaking higher. So those are some of the names and trends that we're paying attention to. Like I said, not a particularly interesting market to take a look at, but again, this pause that we're currently seeing is healthy, but the increasing volatility provides an opportunity to sell volatility here rather than buy. Until we see that breakout one way or another, we don't think it's a good time to outright buy options just yet. In the meantime, as things are quiet over the past week, great opportunity to sell volatility, and we'll update you here on Tuesday, depending on where the markets opens up. But right now, it looks like we're about to open around 314, which means that the 20-day moving average here is holding here. Again, some of the levels that we talked about on Tuesday, which is 318 to the upside, 323 to the upside. Those are your initial targets to the upside. Fill that gap, which it hasn't filled yet. Reach that all-time high or relative recent all-time high before it can continue moving higher. So quite a bit of support here to the upside in terms of trading. So we would expect that if the markets get it back up to that 318, 320 level, it would certainly pause, maybe sell off a little, get up to that 323, pause again if it does get up there, and then if it breaks out, you would need to contend with both of those levels first before it can continue breaking out to the upside. So with that covers what I wanted to show you here today. Looks like we do have a couple of minutes. I'll try to answer a few questions here if you guys have any. Let's see. And thank you so much for those of you that said that you enjoyed the session yesterday with Tom. I really enjoyed doing that, and which is why I'm really glad that we were able to book him again in August and in September. So we have 2 sessions coming up, just I think 3 weeks apart. So we'll get a lot of time with Tom. We'll go over some strategies. We'll also give you guys time to submit your questions beforehand so that we can answer those questions on air. Kel, time to kick the EEM trade. So, again, I actually quite like EEM at this point. Its turnaround. I still believe that dollar is going to continue rally, but EEM continuing to find support, especially if you look at some of the technology and discretionary names in that ETF, certainly has started to turn around here. Are you still good with KMX after earnings? So we rolled the KMX into a June 26th weekly option. So at this point, I think that it's time to potentially take profits. I would look to see if this stock can crack above 100. I think it probably can, but we rolled this so that we were playing earnings without any risk on the table, and that's exactly the type of trades that we're looking to make here. But KMX, I think it's probably time to start taking profits today and Monday. Any weakness in Dollar General? Dollar General has remained fairly strong, and I actually think that I much prefer Dollar General and Tractor Supply to Target, Walmart, Costco, any of the big names, even Kroger's. I like Dollar General. They're smaller, they're focused, and they have a strong digital strategy. How often do you track unusual options activity? I don't at all. I don't really believe in the value of unusual options activity. I don't know if you've followed, every time I've done an unusual volumes trade on CNBC, it almost never works out. I don't know. That's just I don't believe in it. Certainly because at that, when you're looking at unusual activity, you're just guessing as to what the trader is doing. You also don't know what position they already have when they're putting on that trade. So you might think that they're doing something when the reason for getting into the trade might be completely opposite from what you're expecting because they have an underlying position that they're hedging. So if you see a lot of put buying, you're thinking, oh, the stock's going to move lower, but it's really someone who has a lot of stock and they're trying to hedge their position, right? So you never know what the rationale behind what someone's trading. So unusual volume, in my opinion, is really more of an educated guess at best, and at worst, you're trading the completely opposite of what someone intended to do. So that's why I don't track unusual activity. I rolled with you, so looking to close out today. I took profits in Dollar General. Is it time to open another? there's always opportunities here in the markets. I'm not playing Dollar General anymore. If it breaks back above 191, I certainly think that you might move higher here. And it hasn't seen that momentum yet. So I don't see a lot of momentum here in Dollar General at the moment. So with that, I want to thank everyone for taking the time out here this morning rather. Again, I want to thank our members for continuing to support us and allow us to do this every single week and bring guests like Tom back and be able to provide this type of research and give you guys this type of opportunity to learn from us and trade with us. So thank you so much to all of our members. And if you're thinking about joining, you can join using this link here on your screen. It's just $75 a month or $500 a year. It allows us to continue building our platform, this research that we provide, and we're constantly adding new functionality. For those of you that may have noticed in our market observation emails on Monday, Wednesday, and Friday, we have now added income reports and some income observations as well, because I know a lot of you like to sell cover calls and cash secured puts. So those are really designed to give you a better understanding as to how we're viewing those markets as well, not just these directional plays. So send us your feedback. Let us know how you like those, and we will send you the recording here as soon as we're done. Thank you so much. I hope you guys have a great Friday.